Ladies and gentlemen, good day and welcome to the Allcargo Logistics Limited Q2 and H1 FY2024 earnings conference call hosted by Dolat Capital. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Jain from Dolat Capital. Thank you, and over to you, sir.
Thank you, Dorian. Good afternoon, everyone. On behalf of Dolat Capital, I welcome you all to Q2 FY24 earnings conference call of Allcargo Logistics Limited. We thank the management for providing us the opportunity to host the call. From the management side, we have with us Mr. Ravi Jakar, Group Chief Strategy Officer, and Mr. Deepak Shah, Group CFO. Now, I hand over the call to Mr. Ravi for opening remarks, followed by the question and answer session. Thank you, and over to you, sir.
Thank you, Abhishek. Good evening and a very warm welcome to everyone on our Q2 and H1 FY2024 earnings conference call. Let me take this opportunity to wish you all a very happy new year, the new Samvat 2080. May it bring prosperity and happiness to all. We have uploaded our results and earnings presentation on the stock exchanges as well as the company's website, and I hope everyone had an opportunity to go through the same, which includes the results as well as the investor presentation. As mentioned, today I'm joined by my colleague Deepak Shah, and we would endeavor to provide you brief highlights from the quarter and the half year gone by, and also respond to your questions with utmost sincerity. To begin with, let me speak a bit about the macroeconomic environment. The global economy is expected to slowly recover from the pandemic. However, the global trade flows recovery has been relatively even weaker than what we had expected, and this is in line with the economist expectations. We have seen that several factors continue to raise concerns, such as the muted Chinese trade outlook, geopolitical tensions posing an upside risk to fuel prices, and weaker than expected pickup in pre-Christmas stocking, which is usually seen leading to increased shipments from July end. That uptick has been relatively sluggish as well. China, a country that plays a major role in global trade, is also grappling with its internal real estate crisis and diminished external demand. Chinese exports for the month of October shrank 6.4% year-on-year. As per Reuters report, we also understand that China's official Purchasing Managers Index last week showed both new export and import orders shrank for an 8th consecutive month in October, which basically continues from the Chinese New Year gone by. This suggests that manufacturers are struggling to find buyers overseas and ordering fewer components domestically as well. Among the other major economies that impact global trade, such as the US and UK, too are facing sluggish demand growth. Although, on a positive side, the risk of banking instability has softened, but the trade outlook remains cloudy. The International Monetary Fund FY2024. Coming to Allcargo Logistics and our business operating under various subsidiaries, I would like to share a few business updates. First, on the corporate action side, as you would have noticed, the board has approved the issuance of 3 bonus shares. This decision is aimed at improving the liquidity allowing for broader-based participation of shareholders in the company. Besides, this should also facilitate the strategic restructuring plans that we have been pursuing. The company has built significant reserves over the years, and the issuance of bonus shares will use less than 15% of the available reserves, which is a sign of company's health. The company also recently demerged two businesses which were listed in the quarter gone by on 10th of August, and the board considered it appropriate to issue bonus shares once the demerger proceedings were completed, and in this board meeting for the quarter ending September 2023. The company has exhibited strong performance over the last several years and taken significant initiatives to deleverage the balance sheet, which has resulted in a very low net debt as of September 30th. And my colleague Deepu will talk more about it. If you look at it, this is remarkable considering the recent spree of acquisitions. We acquired the balance shares from minority shareholders in Gati Express supply chain as well as in Allcargo supply chain. We also recently increased our shareholding in Noricon to 90%. Besides the acquisition in Germany earlier during the year 2023. All of this has been enabled to a large extent by strong internal accruals from the businesses. On the international supply chain side of the business, while the current macroeconomic environment has unexpectedly led to significantly lower performance in recent quarters, the company is hopeful that the prudent approach by the company over the years that led to a very strong balance sheet will provide a strong base for future growth. The business, which sits under the company's flagship subsidiary EQ Worldwide, is driven by a completely asset-light approach, with digital strategy being the fundamental pivot for future growth. And I'm glad that all our digital initiatives are tracking well on schedule. Further, EQ Worldwide continues to strengthen its global market leadership in the LCL consolidation business on account of significant efforts and investments in acquisitions, acqui-hiring, and transformation of the business on an ongoing basis, despite all the challenges and headwinds. I would like to highlight here that most leading international forwarders have reported a volume decline ranging from -4% to slightly lower in the quarter 2 FY24. This was accompanied by a decline in yields ranging from -25% to -38%. In comparison, our LCL volumes are down 3% year-on-year, and FCL volumes have remained flat. In terms of the LCM volumes, we estimate that our key competitors operating globally are significantly lower on a year-on-year comparison. We have highlighted that a recovery might not be visible immediately, but we continue to focus on our market share efforts along with cost efficiencies. In line with our improved disclosures, we shall continue to keep our various stakeholders updated on the near-term market developments through our monthly operational release. As we have stated in the past, the international supply chain business operates on a January to December calendar year budgeting. Therefore, we are also in the stage of budgeting for the next year, and in the due course of next couple of months, we would also have a better forecast and visibility on our next year's budget and the 3 years business plan, based on which we also intend to share our revised guidance in the coming months. Moving on to our express business, the company is making remarkable strides, consistently delivering top-notch service levels while continuously striving to enhance operational efficiency. It was somewhere around the early 2023 that our operational indicators started to fall in line on the back of transformational initiatives and also the suitable infrastructure coming up. The company has achieved strong performance in Gati Express and supply chain in terms of volumes, driven by increased demand, driven by infrastructure amplification, sales acceleration initiatives, and also on the back of good domestic festive season demand. You might be aware that we have recently launched the Bangalore Super Hub and remain on track on the infra rollout front, a majority of which is already accomplished. Additionally, the company remains steadfast in its commitment to improving EBITDA on the back of operating leverage through increased revenue and volumes, and that should improve the overall profitability as well. So that outlook on Gati Express Supply Chain, which is the operating entity, continues to remain strong and is backed by the demonstration of strong volume and growth in the quarter to FY24. Detailed in highlights and have already been provided in the Gati call, Gati already being a separately listed entity. Coming to the contract logistics business, which is housed under Allcargo Supply Chain and is now a 100% subsidiary of Allcargo, I am glad to note that that business continues to deliver robust performance. Recently, the company has set up a state-of-the-art Grade A chemical warehousing facility at its mega multi-user chemical warehousing complex at Udan in Navi Mumbai. This has been set up for one of the largest chemical companies in the world and is a hallmark of quality excellence in the country. The business, besides the niche chemical segment in which it continues its market dominance, has now started to grow rapidly in the e-commerce space, as well as other opportunities in warehousing ranging from auto components to furniture and other CDIT domain opportunities. In facilities where we store hazardous chemicals, it requires strict adherence to highest safety standards and statutory compliances of international standards, which demonstrates the capabilities underlying in the Allcargo supply chain business. We continue to manage a little more than 5 million square feet warehouse, and we have seen a good pickup in volumes, revenue, and profitability in this business. Compared to last year, there was also a portion of business which was a low-margin third-party logistics kind of an opportunity which was pursued for a period of time for specific reasons, which is not continuing, and that is why the expansion in profit margins is seen to be healthier as compared to the revenue margins. A part of it is also contributed by capitalization of lease expenses. In terms of the future prospects, we see strong demand. We have a robust pipeline in this business, and we are now already invested in people capabilities for solution design perspective. We are participating in greater set of opportunities, and we have a very healthy pipeline which provides good visibility for continued growth in the coming quarters. That was a brief snapshot of all the three businesses operating under Allcargo Logistics. I will now hand over the call to my colleague Deepal for his comments on the reported financials, and then we can get back to further discussions in form of Q&A. Thank you. Over to you, Deepal.
Thank you, Ravi. Good afternoon, everyone, and a very happy Diwali and a happy New Year to you all and your loved ones. I will now discuss the performance for Q2 FY24. Our revenue has declined on a yearly basis owing to a much stronger base and a different macroeconomic environment. The consolidated revenue for Q2 FY24 stood at 3,307 crores as compared to 5,055 crores in Q2 of FY23 and 3,271 crores in Q1 FY23. The consolidated EBITDA for Q2 FY24 stood at 118 crores as compared to 139 crores in Q1 FY24. The muted profitability along with the slightly higher depreciation has led to the PAT, profit after tax, for the quarter ended September 23 declining to 16 crore as compared to 195 crores for the same quarter last year. Point to note is that our balance sheet remains very healthy with a net debt of 120 crores as of September 2023. Now moving on to the business segment-wise performance. I will start by discussing the performance of the international supply chain, which is the largest business. The demand scenario continues to remain weak, like Ravi said, and competition remains high. We continue to focus on outperforming the industry amidst muted demand. LCL volumes for the Q2 FY24 stood at 2.3 million cubic meters as compared to 2.4 million cubic meters for Q2 FY23. On the FCL front, the volume of Q2 FY24 remained flat year-on-year and stood at 152.8 thousand TEUs. The ISC business reported a revenue of 2,795 crores as compared to 4,614 crores for FY23 and 2,823 crores for Q1 FY24. The EBITDA for the same period stood at 65 crores as compared to 111 crores for Q1 FY24. Moving on from the ISC business to the express business under Gati, the segment continues to deliver strong performance with higher emphasis on improving operational efficiencies. The volumes for Q2 FY24 stood at 333 KT as compared to 283 KT in Q2 FY23, a remarkable 18% year-on-year growth. Revenue stood at 385 crores for Q2 FY24 as compared to 370 crores for the previous quarter. EBITDA stood at 15 crores for Q2 FY24 as compared to 21 crores in Q2 FY23. An important milestone for the express business was successful launch of its Bangalore hub. Moving on to the contract logistics business, which sits under the Allcargo Supply Chain Private Limited. Contract logistics revenue Q2 FY24 stood at 76 crores as compared to 83 crores for Q2 FY23. EBITDA stood at, for the quarter September 23, stood at 36 crores as compared to 29 crores for the same quarter last year. We are confident that this positive momentum will persist in the medium to long term, given the rising demand for warehousing across various segments. We have been consistently providing other key comparative financial indicators in our investor presentations. One can refer to that for more details. With this, I would like to open the floor for questions and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, firstly, I'd like to state that in the opening remarks, we lost you in between, and there was no intervention from the operator as well. So just request you to add those sentences in the transcript if possible. So my first question was that we had taken many initiatives like digitization, direct sales, and other many cost reduction measures as well previously, so that whenever there is a fall in realizations, our EBIT per TU is still maintained at a certain level. So this quarter, we could not see those benefits reflecting in the numbers. So could you give us some kind of analysis as to why and how do you expect to see the EBIT per TU levels in the coming quarters, considering that we are expecting, considering the weak macroeconomic outlook?
Right. I'll respond to that. Meanwhile, just to reconfirm, Deepal, were you able to hear me while I was speaking in the opening remarks?
Yeah, Ravi, I could hear you, but then opening remarks was fine, but somewhere in the middle, I also got dropped out. So,
Okay. So anyways, I would request the team to make sure that the transcript is duly recording everything that was spoken, so that if anything is missed out by any participant, that can be referred to later. So coming to your question on the EBIT per TU, I would break that down into two components. It comes down from GP per TU and then down to EBIT per TU. First part, which is GP per TU, is driven by a combination of how we maintain our trade lane dynamics and how the operating market environment is. Now, like I mentioned, the operating market environment has been muted, which impacts the gross profit. At the same time, on the trade lane side, we did take initiative to expand into some new trade lanes in strategic locations. For an example, some of the Latin American countries into European markets, in Asia into Latin America, and a few other strategic trade lanes, which, as you build them out, tend to be loss-making. And at the same time, they're quite strategic from a long-term growth perspective. So some of those initiatives we have continued to pursue. We did not choose to drop them. So to give you a scale of sense, if I was to talk about all the 2,500 trade lanes that we operate, and we carve out all the loss-making trade lanes at the gross profit level, that number for the quarter could be close to about $1 million. Some of the non-strategic ones might contribute to about 25%, which we could temporarily, bring down, and that should create some positive impact, not significant, but majority of that cost we would continue to take as a hit in terms of developing the new strategic trade lanes. The macroeconomic environment, as it improves, typically tends to help us with better utilization. And as you could see from our operational updates in the investor presentation as well as the monthly updates, we have continued to see dropped utilization, dropped ratio of 40-foot containers, which are all operational parameters, which should improve on the back of improved demand. And as the markets have corrected, one thing which we have been able to do is we have fallen relatively less as compared to the competition. And that means that as the recovery kicks in, we should be the fastest to recover as well. Now, that is something which is a combination of, a bit of strategy on the trade lane dynamics, but largely driven by the operating environment. However, where we potentially or should have done better is on the line items between gross profit and SG&A. During the first half of the year, largely through the first quarter, we were anticipating that the trade environment should improve. And there was a little bit of a minor pickup in the month of March post-Chinese New Year, and that kind of created a belief that the trade could be normalized, which, however, did not happen. And we only started acting on the cost side below the gross profit from August onwards. And that endeavor has continued now through the last few months, and we would conclude most of the cost initiatives by end of December. Now, some of these require strategic restructuring in the organization. Some of them are about eliminating some positions by way of automation. Some requires relocation. And typically, most of these activities have a lead time of 3 to 6 months. And during such time, there are also severance costs, switch costs, etc. associated. So as we conclude these initiatives till the end of December, there could be a continued impact until Feb or March. But beyond that, we should see an improved state on the cost side, which means that the SG&A cost as a percentage of revenue or gross profit should come down. So that's something which we expect should be visible from the month of March, April onwards, as this point of time would have some bit of severance costs as well. However, what we would be in a position to do is possibly for the quarter of December, when all these initiatives would have been completed, we could potentially provide a ballpark indication of the quantum of one-off severance impact, which would not continue beyond the Jan to March quarter, and that would give an idea about the impact on the SG&A cost improvements. In hindsight, the organization could have been more proactive from the early part of the year as compared to starting some of these cost initiatives in August, which could have advanced a bit of, reduction, which could have basically helped us maintain healthier EBIT per TEU. However, now that we have taken some of the cost initiatives, we believe that should contribute to some extent. And as the trade volumes rebound, as the utilization starts building up, we believe that the EBIT per TEU should improve. So I would say, putting these in perspective in terms of timelines, we should see EBIT per TEU improve from the April onwards. And we could still call out some of the exceptional costs in the Jan to March quarter. October to December is likely to remain similar. I hope that provides a decent perspective on how it is playing out and what we are trying to do.
Yes, sir. So secondly, you mentioned that till the Chinese New Year, we are expecting that demand to remain muted. So given that this quarter, last 2 quarters, we have seen significant impact due to the lower demand. So, and we have seen a drop in our profitability levels. So going forward, especially in 3Q and 4Q partially because of the Chinese New Year. So do we expect to remain profitable, or do you see any kind of scenario because of the SG&A cost and then lower demand to go into losses?
No, so I don't see us going into losses in any of those scenarios. Also, to further carve out, some of the performance is also muted on account of two big countries which have actually been in the losses, which is US and Germany. And in these two countries, we have already seen some degree of reversal on the trends because some of the outsourcing and cost reduction initiatives are already started around August, September, like I mentioned. So in keeping that into mind, unless the economic environment was to deteriorate further, we should only see an improvement from this quarter onwards. If there was to be continued deterioration in the economic environment, then we could see it being flat. We do not foresee a scenario of the performance going further down from here. But it may not see a significant uplift over the next 2 quarters. And like I said, the impact of cost reduction initiatives as well as the improvements in the macroeconomic environment should potentially start from Chinese New Year around mid-Feb and Feb. And that's where we should possibly start seeing some degree of an upward movement. That's our anticipation right now based on what we see on the ground.
Sir, for the third quarter, given that now we are past 45 days for the third quarter, so are you seeing any kind of an uptick in demand as compared to the second quarter? And if so, even if we can maintain a similar volume, can we assume that this is the lowest for our EBIT per TEU?
So I would say that we are not seeing any demand uptick. The environment continues to remain flat in terms of the overall demand outlook in the market. In terms of EBIT per TEU, our best estimate is that it should remain flat and should grow as on account of two initiatives. One, cost reduction below GP, and second is the turnaround in macroeconomic situation. And the third factor is reversal in performance of specific countries in our business portfolio. So a combination of these three things should help. On the first one, on the cost reduction, I have a more definitive visibility because those are completely controlled internal initiatives and should be completed by December, and with some severance on-off costs still being there in the Jan to March quarter. From April onward should be a clean improvement. On the macroeconomic environment, our estimate is beyond Feb New Year, things should improve. That is something which is based on an assessment of ground reality and what we also hear from global trade experts and economic experts. On the loss-making offices turning around, we have seen positive momentum over the last couple of months. So that trend should continue and should also, help improve the bottom line. So all in all, if you read into these three trends, the performance should remain range-bound for the next quarter and then perhaps start to improve primarily from the April quarter onwards is how we look at the situation right now. And of course, these are based on various estimates, like I mentioned.
Okay, sir. And so could you give us any insights on the realization front for this international supply chain business? So this quarter, we are at 114K per TEU. And we are given to understand that given that freight rates have already come down to pre-COVID levels, so because of a lower demand scenario, do you see the realizations going down further if there is any pricing pressure or anything? Could you give us any insights on the realization front?
Yeah, so we were anticipating that there will be an impact on the ocean freights on account of, trade disruptions getting normalized. This is I'm referring to 12 months ago. However, as the economic slowdown also kicked in on the back of, the trade disruptions going away, the freight rates have dropped significantly, now going back to not just pre-COVID levels, in some trade lanes even below the pre-COVID levels. However, as we have maintained, that impacts the FCL business largely. On the LCL business, the challenge is that when freight rates become much lower, some of the volume from customers can switch to FCL, which leads to further pressure on the volume side. LCL profitability is still largely driven by the utilization in the box and how much of 40-foot boxes can we carry, and that's something which has remained almost close to 10% below the last year's levels. And that is where we believe the improvement is likely on the back of volumes and the trade recovers. And in terms of realization, I would recommend that when looking at the LCL business, we do share data on the LCL and CBM, and that can possibly help you get a better perspective as we charge revenue on a per cubic meter basis.
Sir, if there is a scenario for realization per TU...
We request you to please rejoin the queue for follow-up questions. The next question is from the line of Jia Shah from Wealth Securities. Please go ahead.
Hi. So my question is regarding the plan that you've mentioned for a more simplified structure involving Allcargo Gati and Allcargo supply chain. Could you provide any update on the progress or offer a potential timeline for the same?
So this is something which has been under consideration, and like we have provided an update in the past, the board has advised us to engage with advisors on potential structures and various advantages or disadvantages of the same. And it is still a matter under discussion, and we cannot provide any specific updates since the discussions are still underway and there's no concrete decision at this point in time. However, like we have maintained in the past, any outcome would be towards simplification of the structure, and we have continued to build synergies between the express and the contract logistics business, which now also are under the common leadership. So to that extent, strategy is clear in terms of the approach and structure. Things are still under discussion. And like I said earlier during my comments, the recent initiative of providing bonus shares should also potentially aid the restructuring plan. Beyond that, it is not possible to share any further details at this point in time. But as we make any progress and make concrete decisions approved by the board, we definitely come back to all shareholders and stakeholders.
Okay, all right. Thank you.
Yes.
Thank you. The next question is from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hello, sir. Am I audible?
Yes, you are.
Yeah. So first of all, happy Diwali, sir, and thank you so much for taking my question. So just wanted to get a sense. I think you partly answered my question. So if I can get the correct sense, our H2 will also be range bound such as H1. It will be on the similar trajectory as H1, and we can see volume pickup in FY25, right? Is that a fair way to look at it, sir?
So that is largely correct. Our anticipation is that typically the Chinese New Year, which falls in the month of February, is typically a low season after which the pickup starts. So December usually is also has been, the demand forecast you can typically see 2 months out because when you're booking cargo, and considering the ocean voyage. So we are already in mid of November. So it appears that the next few months, 2-3 months, would remain muted on the demand side, and therefore post-Chinese New Year, which is end of Feb onwards, we should see pickup. That's our anticipation. And that, of course, yes, means that the Q4 would also be largely a similar trend. And from April onwards, we should see recovery. That's what is our estimate at this point in time. You are correct.
Okay, sir. Sorry, sir, for the disturbance. So just also wanted to, I think I got cut in the middle in the call. So why has there been a sudden spike in a depreciation, sir?
So I would request my colleague Deepal to take that question. Deepal, you would like to take that up, please?
Mr. Deepal Shah, your line has been unmuted. You may proceed. Can you hear us?
Yeah, am I audible now?
Yes, you are audible, sir.
Sure. So, if you remember in the last quarter, we had acquired the balance 38% in the contract logistics business, which made the ACPL subsidiary into a 100% subsidiary allowing us to consolidate line by line. Now, that acquisition happened end of May. Last quarter, it was only 1 month of depreciation from that business which was added. This quarter, we have all the 3 months depreciation added from that business. Contract logistics business operates through leased warehouses across India. And because of the lease accounting, the AS116, the higher amount of depreciation from the contract logistics business has got stuck into the current quarter. That's the reason the depreciation has bumped up.
Oh, so sir, our Q2 numbers of so leases would impact our interest costs as well. So our interest and depreciation are not one-off; they'll continue at these rates. Correct, sir?
So Q2 will continue. The Q2 will be post-acquisition. Q2 numbers will be...
Q2.
Yes, that's correct.
Yeah, and so just one last query, sir. So with this, our margins have been severely impacted on a PAT basis. Where do we see a possibility that it could further deteriorate? Because at around 17 crores PBT, that would have a higher impact on us. We would have very less margin in terms of our EBITDA also, right? So is there a possibility that, this could further deteriorate currently? And how confident are we that FY25 would start on a better note, or is it just that we feel that bottoming out has yet not happened? That's the only question that I have. Like, if I could make sense.
Yeah, so I just responded to the same question actually, but I would just summarize again. The improvement in performance would be led by our internal initiatives on cost reduction, which is the clear 100% visibility internally, and that's something which is showing results, and net of severance costs, etc., should definitely make positive contributions from April onwards. On the macroeconomic environment, we are hopeful of a recovery. We cannot say for certainty, but we definitely do not see the situation deteriorating with the inflation falling in control and with the economic indicators suggesting that the trade could see normalization in the following months. We believe that the trade should normalize. So in terms of the performance, what we see, we believe that some of the factors on external side might remain flattish, while internal initiatives could drive up the cost initiatives, and therefore there should be a positive movement from which should fully reflect from April quarter onwards. That's what I was just responding to in detail. And our team would share the transcript. I would request you to refer to that for further detailed insights as well. Thank you.
Okay, perfect, sir. Thank you so much, sir. All the best, sir.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Himesh Desai from Dolat Capital. Please go ahead.
Hello, am I audible?
Yes,
yes.
Yeah, right. So I just have a couple of questions. So the first question would be on the international supply chain business. How is the share of India compared to US and Europe?
Yeah, so the share of India in terms of the top line has marginally increased on the account of Indian business holding better than the rest of the economies. In terms of profit, the share has gone up significantly on a relative basis because India continues to do better as compared to some of the Western Europe and Americas. And like I was mentioning, a couple of large countries had also been on the loss side, which means that the share of India would have gone up. We believe this share would remain on a higher level and should possibly also normalize as other countries recover in terms of trade volumes and therefore improve performance for us as a business as well.
So would you be having an absolute number in terms of percentage, a rough idea?
We don't share, in that sense. However, you could look at the standalone performance of Allcargo. Basically, since the express business and contract logistics businesses are under the subsidiary, standalone business is effectively the business of international supply chain operating in India and some of the corporate costs sitting in there. So if you look at the standalone numbers, you can do some analysis on that. That would be my recommendation.
Okay, thank you. And on the exports part, a lot of the dealers have already completed their inventory destocking. So how do we see volume growth going forward?
So like I mentioned, it appears that from a timing point of view, we haven't seen much pickup for December, and then towards end Jan, Feb, you have Chinese New Year, which typically means a relatively slower trade movement. So we believe that the trade pickup should happen post Chinese New Year, which is towards the end of Feb, early March. That's our expectation at this point in time. And that should also mean a few more additional months of the inflation cooling off in Western economies, and that should improve the demand outlook. And inventory destocking has already happened, as it is visible from ample warehouse space available easily across Europe, Americas, and even parts of Asia, which was not the case 12 months ago.
Okay. And which would be your top 5 countries, and could you help us with the market share over there?
So we are very strong in Western and Northern Europe. We have more than 40% market share in Nordic countries and an extremely high share in Belgium, also close to 40%. And in UK and France, also we have a high share. India, of course, we are market leaders in the international supply chain business. And we are also rapidly improving our market share in a lot of Asian economies such as Indonesia, Philippines, Vietnam, and even the main market of China. In terms of the size of the market, clearly India, China, US, and some of the bigger Western European countries would form the biggest part of our revenue and volumes in this business.
Okay. And just the last question, are there any progress of new acquisitions in Fairtrade, Germany?
No, so we continue to integrate and rationalize the costs, because unlike other acquisitions which were plug-in, this is an acquisition which is also a merger in a way with our German operations and the Fairtrade operations finding synergies, and that process continues, and no further developments beyond what is already being shared.
Okay, thank you.
Yeah, all right, thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of that's Nirav Savai with Abakkus. Please go ahead.
Most of my questions are actually answered. Just a couple of ones. You said something about non-strategic trade lines. So can you just help me out with the contribution in terms of volumes, and how much does it contribute at EBITDA level?
So like I mentioned, non-strategic trade lanes could be roughly about negative $200,000 for the quarter. These are basically trade lanes which are business trade lanes, but not strategically important to be continued in loss, and therefore there could be some opportunities for rationalization.
Okay, so they are about $200,000 in terms of loss at EBITDA level, right?
So trade lanes, you typically look at the gross profit level because the manpower cost or admin cost doesn't change with trade lanes.
Right. And this contributes what percentage of overall volume?
This will be a very minuscule portion.
Very minuscule, right. And lastly, on this 38% stake which we acquired in our supply chain business, what was the outflow there behind that? I think the announcement had happened in the month of March, but as you said, it happened actually in the month of May. So what has been the cash outflow on account of this acquisition?
Sure. Deepan, you would like to respond to this? Operator, can you check if Deepan's line is unmuted?
Deepan, sir, you're not audible if you are speaking.
Yeah, am I audible now?
Yes,
That's audible.
Yeah, sorry. Yeah, it was around, at the gross level, the total net outflow was around 120 crores because we gave away the CCFF business. So yeah, that was around the net outflow.
And all three put together, if you see KW with this supply chain and the another one which...
around 405 crores. So 525 crores is what between KWE and contract logistics business is the outflow in the Q1 and YTD Q2. I mean.
Okay, and also we had increased our stake in Nordic contract to 90%.
So
was it about 180 to 200 crores there?
Yeah, so just to add to that, like people mentioned, about 525, 530 crores in the domestic acquisitions and the international acquisitions of Fairtrade in January and Noricon later in the year put together would be approximately 250 crores. So all put together, we're talking about roughly about 750, 800 crores of acquisitions.
So this has all happened in the first half of 24 only.
Correct.
All right, that's it from us. Thank you.
Thank you. The next question is from the line of Marcel, an individual investor. Please go ahead.
Hello. Yeah, my question is regarding this express distribution. I hope this is a Getty business in India mainly.
Yes, the express business is the business operating under Gati Express and Supply Chain, which is a subsidiary of the listed entity Gati Limited.
So, it is very, disappointing to mention that, in India, all courier business are flourishing. I know some of the business who happen to be my distant relative, they are making crores of rupees, whereas their business size is much smaller in terms of the capital investment and so on. So, here, on this business, we are losing significantly, number one. Number two, in the September quarter, we have added about 140 crore rupees additional segment assets in this segment. And corresponding there is increase in segment liability of 30 crores. So net of liability, we have added another 110 crore rupees. So we have invested almost, 1,500 crore rupees. And our result is, almost flat. There is no, increase in the revenue. Although there is a, every 6 months, every 1 year, it is a price increase by the courier company. Plus on the top, if you see the segment result, we have lost last year 24 crore rupees. And this year we are going to lose about maybe 18 crores we already lost, maybe we lost 40 crore rupees. So what is your game plan to reduce the cost of this segment, number one? And what is the game plan to increase more, you can say, for example, this is a corporate customer, what is the target given to the, what is the target given to your sales personnel to have more, to enroll more the corporate customer, and how to turn around this division? Otherwise, this is bleeding from here.
Yeah, so your observations on the impact on the financials in terms of the capital investments invested in Gati and the underlying subsidiary and the current business impact in terms of the PAT contribution are valid. However, I would like to bring to your attention that the strategy at Gati has always been to turn around an enterprise which was loss-making, losing market share with rundown infrastructure, with a magnitude of problems. A lot has been achieved in the last over 2 years of transformational initiatives at Gati. All the hubs have been redeveloped. In the quarter gone by, we saw a significant increase in volume, which also indicates market share expansion for the first time in perhaps last close to 8 years of Gati losing its market share. The management team has also been able to drive significant digital initiatives. The volumes have come back in. The infrastructure is now in place. So we are quite optimistic that the company should start delivering profits as well in the quarters to follow. And it is our belief that has led to the second tranche of investment as well, which we made earlier this year in the underlying subsidiary. Considering that Gati is also a listed company and to be fair to all shareholders, we generally refrain from getting too deep on the Gati discussions, and I would also encourage you to, look at the commentary shared on extreme details in the business around strategies for key enterprise accounts, expansion of the MSME segment as well, in the Gati Limited's earnings call as well. But in terms of the performance of the company, like I said, the operational parameters started to improve earlier this year. The volumes have started to show trend in the last few months, showing a great quarter ending September in terms of the volumes. And we believe that the performance should improve in the coming quarters in terms of the profits as well as the operating leverage plays out. So,
Yeah, Ravi Babu, thank you for the generic response. I do not need a generic response. The point I am drawing is that even if I consider about 15 crore rupees increase in the revenue during September quarter, and now it's 441 crore, so even if I extrapolate by 4, it makes only 1764. 1768 crore rupees, which is even less than the last year. Last year we achieved 1723, or like this marginal increase, like 2068. So by this way, I think we are only passing time. Let me be a bit sharp here, because even I'm surprising that even on a quarterly turnover of 441 crore rupees, we are not EBITDA positive. I'm not even talking about net positive. There are courier companies which are not even doing 200 crore rupees per quarter, and they are making good profit, hefty profit they are making there. Because so it's very clear that your fixed cost base is very high here. Because see, if you are just going to wait for this turnover increase and the revenue share and volume, this is very, very it is not like as if we are just trying to just fix some corner and bottom like this. By this way, it's not going to help out. The cost structure in this business is way high, because I'm surprising, I'm not even talking net positive, I'm talking only EBITDA positive. So at the same time, if you see, for example, our profitability at the console level has significantly have increased the salary by 30 crore rupees. And like during this quarter, our salary budget has gone by 30 crore rupees. There are many companies that listed our Indian because the listed companies in India, wherein the profit was slightly lower than last year. The senior management has not taken any increase. Here we are increasing salary, which becomes sort of a permanent cost. So there is a humble suggestion and recommendation and feedback that something drastically restricting must be done here in terms of cost overall, in terms of reducing fixed cost. Otherwise, see, 1,700 crore rupees turnover and we are the EBITDA negative. Something is drastically wrong. Otherwise, in this kind of turnover, at least we must make 200 crore rupees EBITDA positive. The way other companies, other courier companies, you can many companies. You can say about, for example, this Fly King. You can say for the professional courier. You can say the company DTDC. They all making good profit. So please need some sort of surgical operation needed here. Kindly advise. Kindly update.
Yeah, your comments are duly noted, and we'll pass on to the management team of Gati as well. And I would just also recommend that you look at the performance not at the console level in Gati, because there are other businesses such as fuel stations sitting in the parent listed entity, and a few other businesses historically which have been closed down, which are loss-making. So I would recommend that from the express business perspective, you could look at the underlying operating entity Gati Express Supply Chain performance, and I would also recommend that you could potentially get more insights and direct responses from the Gati management during our earnings call for Gati Limited. Having said that, we'll pass on your comments and observations to the management team. Thank you.
Thank you. We have the next question from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Sir, as you mentioned that there is a slowdown in the business in Germany and China. So what was the contribution in supply chain business 1 year back of these countries, and how much the current contribution?
Yeah, so I responded on that earlier that the contribution of India has gone up because India has been a relatively better performing market. And there are a few other countries which have seen growth from last year, but they are on the smaller size countries such as Brazil and the Latin Americas. We have also seen, in terms of the decline on profitability, we have seen some of the Western European countries, US and China as the most impacted countries. Exact percentage shares on a country basis we don't share, but we'll see if we can provide some indications in the upcoming investor presentation so it can be accessed by everyone. We'll take that into consideration.
Okay, sir. And my next question is from the contract logistic business. So share of the e-commerce is increasing now. So despite that, the margin is very much strong in the second quarter. Will this be sustainable?
So the margin in this business should be sustainable, as we are already investing in white spaces which are already at an optimal level. So it's not that we have a low white space in terms of the staff cost also. We have well provided for the growth initiative. So this is one business which, like I've always maintained, has continued to remain strong for us over the last 6-7 years and continues to both grow well and hold reasonable profit numbers as well. And we see the trend continue in the coming quarters as well.
And my last question on the capex side, how much the capex you have incurred in the first half, and what is your plan for the full year FY24?
Yeah, so our strategy is to be asset light, and therefore we don't see any significant capex besides some of the technology initiatives. But I would also request my colleague Deepal to add on the capex during the last 6 months and the coming 6 months. Deepal, over to you.
Deepal, sir, you need to unmute your line, I think. You're not audible.
Yeah, hi, Ravi. So, you're right. We have an asset-light strategy, so we do not have any significant capexes during the first half of the year. The only, additions, if any, have come from the contract logistics merger. So there aren't, except for maintenance capex and routine IT capex in terms of, maintenance and, buying new laptops or anything or servers. Other than that, we do not have large capexes. And a couple of real estate in terms of, refurbishing some of the premises, etc. Other than that, we do not have any capexes for the year planned.
Thanks, sir. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Yeah, thank you all for joining in, and I hope you were able to respond to your questions, providing clarity and insights as much as we could. I would encourage you to stay in touch with our investor relations team. Reach out for your queries, feedback, and suggestions. It is your suggestions and questions that help us continue to improve our investor communication. And wherever we see a sustained demand for a particular kind of information, we try to include that in our investor presentation for the benefit of all stakeholders. On that note, wish you continued great festive joys, and thank you very much for joining us today.
Thank you.
Thank you. On behalf of Dolat Capital, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.